Hello, this is Brad Bob here, and I want to talk about something really important today, and that is TSP investing. Okay, investing in your TSP for a FERS employee is a big, big deal, right? It's one of three parts of your three-legged stool of retirement: your FERS annuity, Social Security, TSP. Now, what I want to look at today is I have people talking all the time about, well, I've put everything in G Fund. Okay, or I just moved everything in G Fund, or I've always done G Fund, or I've always done C Fund. And most of the time, what I hear when people are talking about stuff like that is it's the people that say, I've always invested in G Fund because, you know what, I'm not a gambler, that's just what I've done. In hindsight, yeah, I probably messed up, but that's what I did. And the truth of the matter is, all you can do going forward is the best you can with the knowledge you have now. But what would that have looked like? I'm curious sometimes, what would it have looked like if that person would have invested in C Fund their entire career, or the stock funds, versus just the G Fund? So I found a way to check it out. Let's look at it. Okay, what I have up here is TSP.gov. Okay, so TSP.gov really has all the data that you need to look at returns. Now, you only have three funds that have been around since 1988, C, F, and G. Then the S&I funds, they came around in 2001. Okay, so we're not going to do anything with those because I want to look at a 30-year time period. Okay, you know, federal employees can retire at MRA with 30 years, right? So that's what I really want to look at. So let's look at it and see what that looks like. So all I did is I took that data from TSP.gov, put it into my software here, and we're just going to see what kind of money a person would have if they did a couple different things. So I started with an investment of $500, okay, and then investing $500 a month. All right. Now, if you think about it, that is not very high. All right. If you take an employee starting out with $50,000 income and they put 5% in their TSP, that's $2,500, and then they get matching. Okay, you get matching of $2,500. If you put in 5%, they put in 5%. So that gets you to $5,000, really close to the $500 a month of $6,000. So if that employee puts in a little bit more, 6%, 7%, okay, then you're getting up to that $6,000 a year. And that's just starting. So the only thing I'm increasing here is the $500 annually due to inflation, okay? We all know that the longer federal employees work, the more that they tend to contribute to TSP, okay? So I'm not factoring any of that in. I'm just looking at a 30-year career, investing $500 a month into TSP between the employee and the agency, okay? So let's look. I have three different scenarios here. Portfolio 1 is 100% C Fund, okay? You can see $1 million, almost $1.1 million. Portfolio 2 is 100% G Fund, significantly lower at $392,000. Big difference. Portfolio 3 is 60% C Fund, 40% G Fund. Okay, you can see you're in between the two. It's $768. So just tells you in hindsight, if over the past 30 years you would have put $500 a month into the C Fund, you're looking at about $1.1 million. G Fund, you're looking at $390,000 or so. And then a mix of 60-40, 768, 769. Then risk. You can see some risk numbers. I'm not going to go into all these things, some technical numbers, but one really simple one is maximum drawdown. So this is the reason a lot of people do not invest a lot of money in the C Fund or S Fund or I Fund, is because they do have drawdowns from time to time, and sometimes big ones. All right? And a drawdown is simply the time an investment hits a peak until it comes down. When it starts to go down, until it hits a bottom and then comes back. Okay? So to put it simply, if you have $500,000 in the C Fund and you experience a 51% drawdown, your balance would have gone down to a little bit under 250,000 before it started to climb back up. Okay, and that may be painful. In fact, that's probably going to be painful for most people. But if you stayed invested, it shows us here you would have recovered, been above that $500,000, and this does not include any new contributions, but you would have been above that $500,000 by March of 2012. That's when you would have recovered. All right. Recovery here, you're looking at 31% drawdown. Recovery here, you would have recovered by December of 2009 with a 60-40 portfolio. That is really quick for a 31% drawdown. So let's do one other thing. Okay, so we looked at 30 years there, 30-year career. Let's go back to when these funds started and just add a few more years on. So we did have 30 years, and now we're adding 5 more years on. Okay, 5 more years makes a big difference. They say it's not timing the market, but time in the market. You add 5 years, all C fund, you're looking at 1.8 million. All G fund, you're looking at 558,000. And then 60-40, you're looking at 1.2 million. Okay, that's interesting. That's more than double what the G fund is. And you still have the same drawdowns here because those occurred from 2007 to 2009. Right? You can see that. See the graph here. You can see your big drawdown. Right here's where you had the big drawdown through March 31st of 2009. But I just want to show you guys these numbers. Okay, this is something maybe be good to pass along to younger federal employees. But then again, this is something even older retiring federal employees should see. So if you're retiring at law enforcement, you can retire at 50 or even earlier. And regular federal employees, you guys can retire at MRA, which is 57, maybe a couple months earlier if you're almost there. That depends on your birth date. But you could easily have a 30-year or better retirement. And if you want to see some growth and some income from your investments, okay, you're going to have to take some risk, and you're still going to have to invest some money in stocks. So this is something that I think would be good for you to see too, okay, even if you're taking withdrawals. And they say history is no guarantee of future performance, which is true, okay? It's no guarantee of anything. But yet, I do like to look at history. I do like to look at what has happened in stock markets, what's happened in different cycles. What would happen here if you invest in the C fund versus investing in the G fund. So hopefully this can provide some valuable information for you, give you some takeaways from this. I'll let you be your own judge to see what your takeaways are and how you want to invest going forward. I'd be curious to know. Let me know in the comments. Does this impact your investing at all? Are you going to change anything going forward? That's it. Thanks for listening, guys.